Prop trading is all the rage these days, and I've received so many questions asking whether prop trading is worth it or which prop firm to go for. But not all is rosy in the prop trading world, and a lot of negative news has emerged of late. Let's go through some of them. For those new to prop trading, the promise offered to traders is very simple. You prove that you are a profitable trader by passing a trading challenge, after which the prop firm issues you a so-called funded account, usually at least 100k or more, and you get a split of whatever profits you make. But in actual fact, these funded accounts are all demo accounts. These trades never reach the real market, generating no actual profits. Payouts come solely from challenge purchase fees, not real trading profits. To be fair, despite the misrepresentation, this is a great business model because it really plays to the fantasies of retail traders. Now anyone can become a funded trader, which is like a badge of honor, and you can tell all your friends that you're now trading a 100k account at the minimum. And this leads me to the first problem, the worsening reputation due to the ever-present risk of fraud. Like brokers, prop firms rely on one very important assumption. The vast majority of traders need to lose money. In the prop trading context, this means they need to fail their challenges and keep paying the challenge fee. Almost all brokers operate a hybrid A and B book model whereby the profitable traders are moved to the A book and their trades are passed on to the LPs and somebody else bears the risk. So brokers can still generate a profit from the spreads and commission, although it is a smaller one. For these prop firms though, if they are unfortunate enough to get a group of very skilled traders, it is a double whammy, because not only are they not receiving the repeat challenge fees, they now have to grapple with the profit payouts as well. This leads to some pretty serious conflict of interest and has led to some pretty high-profile fraud cases, the most famous of which was the MyForex Funds case. According to the CFTC, MyForex Funds or MFF supposedly offered retail customers the opportunity to become professional traders by using their money to trade against third-party LPs and share in any trading profits. But in reality, it was MFF who was the counterparty to the customer trades. MFF also actively minimized the likelihood that customers trade profitably by terminating their accounts, increasing their commissions to reduce their equity, secretly using specialized software to cause customer orders to be executed at worse prices, and handicapping the extremely small number of successful customers to decrease customer profits and increase customer losses. MFF turned out to be very successful, getting at least $300 million in fees, and a complaint alleges that Kasmi, the guy behind MFF, used the proceeds from the fraud to purchase luxury homes and cars, and make tens of millions of dollars in transfers to his personal accounts. This case has been ongoing for a year now, with no end in sight, so if you have outstanding payments from MyFF, don't hold your breath. To make matters worse, more and more prop firms are now accusing traders of cheating. For example, Karma prop traders had to recently shut down because too many cheaters were passing their challenges, which caused them cash flow issues. Once in a while, I get an email from MetaQuotes telling me what their best-selling EAs have been, and for the past few months, the top-selling EAs have consistently been those that help traders pass prop firm challenges. Stuff like this. The vendor clearly states that the EA will not work for actual funded accounts and is only good for passing challenges, but that clearly hasn't deterred aspiring funded traders. Maybe this is the kind of cheating that Karma was talking about. In fact, this cheating problem has become so widespread that Apex Trader Funding, which has been struggling with timely payouts to clients, now requires traders to monitor themselves and their screens for 2 days before receiving their payouts. Like I mentioned in a previous video about traders trying to scam their brokers, the scamming in the retail trading world works both ways. As more and more traders find ways to game the system, you can expect more prop firms to run into trouble. And thirdly, we have MetaQuotes clamping down on access to US clients. As you probably know, MT4 and 5 are the most widely used trading platforms, with Forex and CFD trading being almost synonymous with MT4 and 5. Now, most of these prop firms don't actually have access to their own MetaTrader servers. What they do is they partner up with the brokers, getting access to the brokers' demo feeds. This is often called a grey label partnership because unlike a white label, the prop firm is being offered a non-branded version of the platform. So for example, Redex Markets is a white label of Go Markets. Redex is their own branding. But for prop firms, it is different. They just quietly use the MT platform without branding themselves as a broker. But unfortunately for prop firms, it seems that many of their clients come from the US, and CFD trading is heavily regulated there. There's only a small handful of brokers that are able to provide trading services to US clients. MetaQuant is now demanding that brokers stop grey labeling their empty licenses to prop firms who accept US clients, and this has resulted in many prop firms having to stop or restrict operations in many countries, for example funds for traders and funding pips. Another possible issue is that MetaQuant doesn't charge for using its demo servers, only its live ones. And seeing that prop trading firms only operate in a demo environment, it is understandable that MetaQuant is getting pissed at its lost revenue. There are still very few regulations in the prop trading world, but as the regulatory environment continues to evolve, we can expect more prop firms to run into trouble. So, with all the problems plaguing prop firms nowadays, should you even bother? Well, my honest opinion is that the best solution to the problem is to avoid it entirely. Only trade with a prop firm if you are really cash strapped or you are after some bragging rights. The risk simply isn't worth it. I find that many young traders, often in their 20s, tend to have a habit of taking maximum risk in a bid to squeeze out as much profit as possible. Older traders tend to value stability and peace of mind much more. You have to decide how much you're willing to risk. If you insist on becoming a funded trader, only pick prop firms that have been around for many years and whose challenges do not have a time limit. You can easily find out which firms meet these requirements. These firms are probably in a better financial position to handle waves of profitable traders, and of course, a track record of success never hurts. Newer firms are probably operating more like a Ponzi scheme. If there are not enough new traders to pay the challenge fees, payouts for funded traders will probably run into issues, and very soon they will likely be out of business. So good luck to everyone out there. If you have had any experience with these prop firms, both good and bad, feel free to share them in the comments.